Hi everybody, my name is Patty Beauregard. I'm a partner in the Stanford office. And my topic today is 10 charitable planning ideas. I love working directly with charities and also with clients who, in the process of preparing an estate plan, choose to give some or all of their assets to charity. I will discuss 10 charitable techniques available to your clients, and of course there are many more. First, I want to give a brief overview of the charitable income tax deduction rules. The rules vary depending on the type of asset your client decides to give and the type of charity that receives the gift. Generally, the donor receives an income tax donation for gifts of cash or long-term appreciated securities up to 30% of his or her adjusted gross income, or AGI. So when a donor makes a gift of cash to a charity, the rules are easy. The donor deducts the amount of the cash gift in full up to 30% of his or her AGI. For example, if the donor's AGI is $100,000, he or she can deduct up to $30,000, which is 30% of AGI. If the gift exceeds this amount, the donor can carry forward the excess deductions for 5 years. And this example assumes that the gift was made to a public charity. If a donor makes a gift to a private foundation, the deduction is limited to 20% of his or her AGI. Outright gifts of cash or appreciated securities. Now, outright lifetime gifts are simple to make. For cash gifts, the donor would simply write a check. For appreciated securities, he writes a letter of authorization to the investment manager instructing him or her to transfer the assets to charity. Now, with a lifetime gift, your client has the satisfaction of knowing his money is invested in a cause that's important to him. Many of us have given gifts to charity at the request of someone else, but when we decide to support a charity that focuses on programs close to our hearts, breast cancer or domestic violence, for example, the gift brings us joy and satisfaction. Only long-term appreciated securities, those held for at least 1 year and 1 day, are eligible for a full deduction. For donors who give short-term appreciated securities, there is little or no tax difference between donating the stock directly or selling the stock and donating the proceeds. In effect, only the basis of the gifts of short-term appreciated securities may be deducted, meaning the price at which the stock was acquired. The second technique is a charitable gift pledge. A donor can make a pledge to a charity to make a substantial donation to be paid out over a period of years. Now, why might a client make a pledge rather than making the donation all in 1 year? He or she may want to spread the payments out so that he or she can fully deduct the donation each year, or they may not have sufficient cash or funds to make the gifts all at once. In appreciation for the gift, the charity will usually keep the donor informed and involved in the work. When a donor makes a pledge, he or she has the opportunity to make a difference and to forge a relationship with the charity. This makes the gift very personal and provides joy to both the donor and the individuals at the charity with whom he or she will interact. This is a gift that keeps on giving. The charity will appreciate having certainty about funds coming in for the term of the pledge, which is very helpful for planning charitable activities and fundraising needs for the coming years. Number 3 is a bequest in a will to take effect at death. Giving a gift at death to a favorite charity can be a memorial gift bearing your name. I have worked with many charities, particularly hospitals and schools, that have received memorial gifts. If, for example, a gift is given to build a library, the library may be named after the donor, if that's what he or she wants. Of course, I work with many clients who prefer to be anonymous donors, and we certainly can make sure that that happens. Charitable gifts are fully deductible in a decedent's estate. The federal exemption right now, we don't know what's going to happen next year, but it's scheduled to be $5.49 million in 2017, and the Connecticut exemption remains at $2 million. If the estate is larger than the federal exemption, the charitable gifts will be fully utilized to reduce the value of the estate. Sometimes people like to give difficult or unusual assets to charities. I have worked in the past with charities that have received gifts of artwork. In one case, the donor did not restrict the gift, but he had hoped in his heart that the artwork would be displayed at the charity, which, by the way, was not a museum. In most cases, gifts other than cash will be sold as soon as possible so that the charity can use the funds to conduct their charitable activities. The fourth technique is the use of beneficiary designations to make charitable gifts. A donor can name a favorite charity as a beneficiary of a life insurance policy or retirement asset. The estate will receive a federal and state estate tax deduction for the value of the gift. For life insurance, in order to receive a charitable deduction, choose a policy that is not being held in an irrevocable trust because it's already out of the estate, so the donor will not receive any further benefit of a deduction. Your client can assign the policy to the charity, or they can name the charity as beneficiary of the policy. The charity will then decide whether to cash the policy in or to keep paying on it. A client has to be comfortable with the fact that now certain people may be looking forward to his or her passing away. It might give them pause if they start getting monthly calls from the charity to see how they are doing. Or think about if a charitable representative comes to your house to count your liver spots and then reports back to the headquarters. It's disturbing, but most of them don't do that. A good choice is a paid-up policy. This way the charity does not have to pay on the insurance. And if the policy is not paid up, a donor can continue to make gifts each year to the charity in the amount of the life insurance premium so that the charity does not have to go out of pocket. Retirement assets are subject to both estate tax in the client's estate and income tax when the assets are withdrawn by the beneficiary. Instead of giving retirement assets to a charity during life, a donor may designate the charity as the beneficiary of a retirement account. A client may wish to give her loved ones assets that will not be double taxed immediately. If a donor has sufficient assets to leave to his or her family or loved ones, but wishes to give a portion to charity, the donor can choose the most advantageous assets to give to his or her family and to the charity. If the donor names an individual beneficiary to receive the retirement assets, as you know, his or her estate will include the assets as part of the estate, and the beneficiary will pay income taxes when he or she takes out the required minimum distribution. However, the charity can withdraw the assets in full without penalty or income taxes. One caution: if your client is married, the spouse must usually consent to a beneficiary designation being made to someone other than your spouse. I'd like to do a brief introduction to charitable remainder trusts. A donor can establish a charitable remainder trust to provide income for life or a term of years for herself and another individual beneficiary. This is a great way for a client to retain income for herself or another individual while ultimately benefiting a charity of her choice. Keep in mind that she will be making a gift to a beneficiary other than herself that must be reported as a gift at both the state and federal level. Upon the death of the last individual beneficiary, the remainder of trust assets pass to the named charity. The donor receives a charitable income tax deduction for the portion that passes to the charity. Again, this technique makes sense when the donor's estate is in excess of the federal and or state estate tax exemptions. A donor can establish a charitable remainder trust at death, and her estate receives a deduction for the portion passing to charity. It's really important to know your percentages. The amount that will be paid out to the donor annually must be between 5% or 50% of the assets. The actuarially computed value of the charity's remainder interest must be at least 10%. So that's 5, 50, and 10%. Those are the percentages. Trust me, we have software that helps us to prepare the analysis for clients, and we have a nifty button that says optimize so that we can get really the best possible scenario. Now, Jesse was speaking about CRATs, CLATs, and CLUTs, and I'm going to be discussing CRUTs and CRATs. We love our acronyms. A charitable remainder trust, or a CRUT, pays a beneficiary an amount determined by multiplying a fixed percentage between 5 and 50% of the fair market value of trust assets revalued each year. Because the payment amount is recalculated each year, this type of charitable trust provides a hedge against inflation. CRATs are less likely to be depleted and fail the 10% remainder test. The charity receives the remaining assets upon the beneficiary's death or at the end of the trust term, not to exceed 20 years. Additional contributions may be made to a CRAT. However, the trust instrument must provide language providing for the valuation of the assets after an addition to the trust. A Charitable Remainder Annuity Trust, or a CRAT, pays the beneficiary an amount determined by multiplying the fair market value of trust assets by fixed percentages between 5 and 50% valued at the time of the gift. The key difference between a CRAT and a CRAT is that the amount that the individual beneficiary receives annually does not change because it's valued only once at the time the gift is made. If the portfolio or assets suffer losses, this can be problematic from the standpoint of meeting the requirement that 10% of the assets must pass to charity. The charity then receives the remainder upon the death of the beneficiary or at the end of the trust term, which is not to exceed 20 years. Absolutely no additional contributions may be made to a CRAT. Number 7 is a donor-advised fund. The client can establish a donor-advised fund with a gift, and as the advisor, the client can then recommend gifts to be made to the charities of his or her choice. The donor, as advisor, can recommend gifts throughout his or her life to charities from the donor-advised fund, both public charities and private foundations. Keep in mind that the advisor's recommendations will likely be honored, but it is up to the custodian to approve the recommended gifts. A donor-advised fund is a public charity. Therefore, the donor can deduct up to 30% of AGI. The 8th technique is an endowment fund. An endowment fund can be established to be held in perpetuity for the benefit of a charity. Funds are often established as memorial funds or named funds and are given to schools, hospitals, and other charities. Typical endowment funds provide that the principal is held forever and the income is to be used for a specific purpose. Endowment funds are a very important part of the financial stability of a charity. Charities count on the endowment funds to pay for their expenses, especially in years when fundraising is difficult. The income earned and sometimes a portion of the principal will be utilized for a specific purpose or for the charity's general needs. Endowment funds are governed by a Connecticut law called the Uniform Management of Institutional Funds Act. Even if the gift indicates that only the income of the fund can be used, the charity can actually appropriate a portion of the principal under certain circumstances. The 9th technique is a private foundation. A private foundation can be established by a trust instrument or corporate entity, but many are formed as a trust in order to provide more control to the donors. Private foundations are often established by a family member with a desire that the foundation become a giving vehicle for many generations. I had the pleasure of attending an annual meeting of a client private foundation in Utah, where I met 26 members of a remarkable family. I was very moved to witness the 3rd generation, the grandchildren, becoming involved, researching charities as grant recipients, and learning to be charitably inclined at very young ages. A private foundation is a giving vehicle that is required to make distributions of 5% of its assets per year. And again, donors receive an income tax deduction up to 20% of his AGI for gifts to private foundations. Trustees or board of directors determine the public charities that will receive grants. These decisions are usually determined at the annual meeting for the coming year, and then gifts are made thereafter. Private foundations are heavily regulated entities because usually all of the trustees and board members are related individuals, meaning family members. Trustees or directors must be careful to follow all requirements to avoid excise taxes. One of the biggest mistakes people make when they are on the board or serving as trustee of a private foundation is engaging in self-dealing. This can take the form, for example, of donating funds to a charity to create a paid position for themselves, or donating funds to a charity for disabled individuals that a disabled family member can take advantage of. I found that none of this is done with bad intentions. Usually, the board member or trustee does not understand the concept of self-dealing or its ramifications. But if self-dealing does exist, excise taxes will be levied against the charity and the self-dealer individually. That's definitely not a good result. We heard a lot about private foundations during the election, primarily how they were mismanaged. I just want to say, as a general rule, don't do what either candidate did with their private foundations. Just know that political activity by a private foundation is absolutely forbidden. We establish many private foundations and provide ongoing advice to clients on their administration. And if your client has a private foundation, they should seek legal counsel to assure they are managing it properly. And they have to be careful with what they report on the 990 PF to make sure that it's consistent with their charitable purposes. My personal favorite, public charity, number 10. I work with a lot of public charities. I create a lot of these. And it is a more favored vehicle than the private foundation from the standpoint of the IRS. When the public charity seeks recognition from the IRS, however, it must show that it will be conducting charitable activities and will be raising sufficient funds from the public. Public charities are less regulated because they are raising funds from the public. The idea is that if the charity is raising funds from the public, donors will not be giving to the charity unless they are convinced it is a genuine charity doing actual charitable activities. We have worked with many public charities who run programs from soup kitchens to education to conservation in South Africa. Public charities can be established as a trust or a corporate entity. In my experience, most are formed as corporations. If a charity decides to form a corporation and it is located in Connecticut, I usually establish it under Connecticut law. Connecticut is easy to work with. However, if the charity is located in New York, I will frequently form the charity in Delaware. The reason for this is that New York is frankly a quagmire. Delaware has a well-developed body of law and is easy to deal with and is a great alternative to New York. A public charity is less regulated and easier to operate than a private foundation. There is greater flexibility to determine charitable purposes, raise funds, and carry out the charitable purposes. Public charities are a lot of fun to work with, they really are, but clients need to keep in mind that they still have to file a Form 990 each year. And if the charity is raising funds, it has to be registered in each state where it is raising funds. And I worked with a charity that was raising funds in California. California requires a charity to register in just about every town, city, district where you raise funds. A lot of people ignore that rule, but you do so at your own risk. They must file the Form 990 every state where they are registered, and perhaps other reports with the Attorney General of each state. We are happy to assist your clients in establishing a charitable giving vehicle that is appropriate for them.